to Good Day Columbus. So a lot has been made lately about the fact that interest rates are once again going up. What does it mean for you and your money? And more importantly, what is your money personality? We're going to find out. You're in luck. Brad Huffman, certified financial planner, is here with us this morning. All right, so Brad, welcome.
Thank you.
I mean, just in general here, the interest rate's going up. Should we be worried?
It depends. I mean, again, your money personality will determine how you're going to be impacted. So some groups want it to happen, and it's maybe not helping them. Others don't want it to happen, and they've got to deal with a new reality.
How much are we talking here?
Well, some people can be huge. So let's start with, if you're a borrower, rates are going up.
So that's our first personality, is the borrower. So to kind of like make this stick at home, we found like some movie characters that fit into each of these personalities. So for the borrower, we're talking Tom Hanks and Shelley Long in the classic movie The Money Pit.
Oh, it's frightening.
Yeah, they kept borrowing and borrowing and borrowing. So if you are a borrower, how are these rates going to affect you?
Well, first and foremost, the biggest borrowing most people do is going to be a mortgage. Has been a pretty big deal. So if we look at the 30-year mortgage, we were under 3.5% just 6-9 months ago. Now up over 4.5%, looking at 5%. So let's just say $100,000 mortgage, 1% increase, $1,000 a year, $20,000 over the life of the loan. So it can mean real money to most people.
Wow. Now we're looking at this here, and it says that it is also going to affect student auto loans. They're likely going to continue to rise, but credit cards won't be affected.
Yeah, well, credit cards are really independently updated by the credit card company. So they've been up here for a while. This is really that, the basic stuff we've enjoyed for a while for cheap money. It's just going to go away. Not as aggressively as it has the past few months, but it's going to continue to tick higher. So fix those rates now if you can.
So you think it's gone? Those low rates are gone?
Those rates are gone, yeah. I think, if you refinance with the past few years, you may never do it again, in my view.
Wow.
That's huge.
That is
exactly
huge. All right, well, the next group that we want to talk about, the savers.
Yes.
The penny pinchers, like naturally Scrooge McDuck.
Yes. Wish I had a few of those pennies in my bank.
No kidding,
but
right?
Yeah, so the savers would love to see rates go up. If you're a saver, you've owned a CD, a savings account, you've seen that rate just obliterated.
Like minimal returns.
Very minimal. Unfortunately, it's not going to change a whole lot. The rates that are changing are primarily long-term in nature. Savings rates, CDs, are dictated by short-term interest rates. So while I would love to go into the bank and get a 5-year CD and lock in 4 or 5%, it's not going to happen. So savers have suffered. Many of my clients are great savers. You're just not going to see that change. These types of rates that are changing are not affecting those short-term rates.
But conversely, though, the ones that it could benefit would be the investors. So our movie profile would be the Gordon Gekko.
Gordon Gekko,
from Wall Street. So if you can invest, then these higher rates are going to be a good thing.
Yeah, it depends on which side of the aisle you're on. If you're a conservative investor, if you own bonds, this could be a difficult time for you, because what's happening is you look at it kind of like a seesaw. As interest rates go up, bond prices go down. So those more conservative investors have to do a little dancing now. They've got to be nimble. You've got to move to the short-term interest rates. Long-term rates have gone up, hurts those bonds. So you've seen some pain. You can do floating rates, you can do short-term rates, but you've got to do something. And this affects most retirees. Many of my clients are more conservative. The bond issue is a major factor. Now, if you're the riskier investor, the stock investor, rising rates aren't necessarily a bad thing, because they're going to be dictated more by the economy. So just because rates are rising doesn't mean you sell everything, you go into the bunker and you stay there. But you do have to be much more nimble, because it's not going to be this easy money we've been used to for the past 4 or 5 years. The trend is in place. It's going to continue, I think, gradually. I don't think we're going to go from 4.5% mortgage rates to 7%. But I think seeing 5 in the next 6 months is probably not unreasonable.
Wow. Well, some great advice.
You should be prepared for that.
Be prepared.
So now, depending on your profile, and of course now I'm going to be thinking about the Money Pit and Scrooge McDuck.
Exactly, Wall
Street all day.
An eclectic group of individuals, It
is.
Exactly.
All right, Brad Huffman, thanks so much.
My pleasure.
Stay with us next on Good Day Columbus. Never giving up on a lifelong dream.
Diana Nyad's inspiring achievement.